Hey, good afternoon. This is Tech Talk Tuesday. I'm David Blake, and today we're going to take a short look at the major averages, see where we might be headed over the next week or so, and also look at some numbers to watch where I think we could run into resistance or find some support. Yesterday, the market was closed, so we don't have much to go on that we didn't talk about in the weekly market letter on Friday. But overseas markets were open, so we can talk a little bit about how that may affect our market as the week starts. First off, China's Shanghai index was closed last Thursday and Friday. And traders were a little cautious on Friday going into the weekend, so they wanted to see how China's stock market would be able to, whether or not it would have a positive opening as the week started after being hit pretty hard last week. It turns out China's market did open higher on Monday, but midday turned down and closed down about 1.8%. After the market closed, China's policymakers promised additional steps to shore up and stabilize that market. And last night, the market rallied another 3%, maybe to put it back in the plus column here. The European markets were up slightly on Monday, and today on the rally on China's market, we're up about 2% earlier today. Okay, so last week was another rough week for investors. The Dow Jones lost about 540 points, down about 3.2%. S&P 500 gave up 67 points, down 3.4%, finished at 1921. And the NASDAQ was lower by 144 points, ending at 4683. And that left every index down for the year. Okay, the Dow's still the weak sister due to the company's international exposure, which are, susceptible in here to the stronger dollar. And the S&P 500 is down about 6.7% year to date. NASDAQ's almost flat, but it was off approximately 1% coming into this last week. However, despite all the weakness in the transports and all, we still are holding around last October 2014's lows, and traders are going to watch that. Now, the Dow Jones Transportation Index, which is down about 14.75% year to date, that and the Dow actually signal a Dow theory sell signal, but I'm not so fast to jump into that, and we'll take a look at why. Okay, first thought I want to show you, and I keep coming back to on these talks, is that whenever a rally in the Dow Jones is most likely to stall. Okay, this chart shows the 50% retracement of the move from the summer highs to the recent low, and usually when you have a significant sell-off in a market or stock, that stock index will rally up about 50% of the total move. Now, for the Dow Jones, it wasn't able to rally that far yet, despite a pretty nice kickback off of those lows. So what we want to look at now is the next level of resistance is where the previous rally ran out of gas, and that puts resistance at around 16,630. Over in here, 16,670. So if we don't get another run of this week, this week, it increases the odds that a retest of the lows is probably in order. As we had a pretty nice start to the week today with the market rallying, I think right now the Dow Jones is up about 16.4. So there's still a little bit of wiggle room for the Dow to move higher before we actually can run into resistance. Again, the 50% level is around 16,850 to 16,9, but last week it stalled out around the 16.7 level. Okay, another thing that we looked at last week that we talked about was all the major averages seem to be have formed a triangle pattern that we want to watch. It's pretty well defined in all these. If the market doesn't hold on to the gains here the next day or so, and we take out Friday's lows of about 16.25, that would probably trigger another pullback to at least 15.3, 15.4, which coincides with the February 2014 level. Not sure if we're going to see that or not. That's probably a worst case scenario. That would probably indicate that we're in a new bear market, and I'm not convinced that that's what's going to be happening in here. Okay, the next slide is the S&P 500 and its 50% level. So you can see here the S&P 500 came a little closer to its 50% retracement, got up to around 1900, but that retracement level is at 2000 on the S&P 500. Until we close above that, we are still in an oversold rally or oversold bounce up to those levels. Now, we did break above a little bit of resistance around 1960, but today we're about 1951. Again, that's right around the resistance level. It needs to clear that, clear at least 1980, where the previous highs were, before we can make another run to the 50% retracement level around 2000. Here's the triangle pattern on the S&P 500. You can see here that if we trade below 1910, that we will break below that triangle break, and that would target about 1800 to 1810 on the S&P 500. That brings in the October 2014 play for investors. So that's still maybe a possibility, but I don't think it'll accelerate from there. Okay, here's the NASDAQ. As you can see, it actually made it back to the 50% retreat. Spent about 2 or 3 days closing up around 4,800, which was very bullish. That shows a little bit of positive divergence, but it was unable to hold that level. And now we've pulled back to around the 40, 46 and change levels. So we want to see if percent picks up and we break below that 46.50 triangle. That would also target the October lows down here around 43.80, somewhere in that area. So we want to keep an eye on that. Again, I'm not sure that's going to happen. Okay, before we look at some of the sectors, there are some positive things that are going on that could be signaling that selling might be slowing down a little bit, and perhaps the sell-off could end up only being about a two-month or so ordeal. And one of the things that traders will look at is sentiment in the market to determine, whether or not we're getting near a bottom. And this week, we actually saw investor bearish sentiment hit a multi-year low. Bearish sentiment is a contrarian indicator. It means that when everybody else is bailing out, it might be time to make a move in the back end of the market. Okay, this is a chart of the percentage of bullish advisors, and this fell to 27.8% last week, which is just above the 26.4% level that it hit in March of 2009. Now that coincided with the bottom of the last bear market that started during the financial crisis. So one thing to note is that these extreme levels don't necessarily ring the bell, but everything's over. But they do usually come within a week or so, and we might want to check on this. This may fall actually maybe a little bit lower this week, but we are now at extreme levels that are multi-year levels, and that's actually a bullish sign for the market. It means that everyone's too bearish. Okay, now this next chart is actually the percentage of bearish advisors, and that was holding down around 14% for quite a while, most of the summer actually, in spring, and that jumped up to 26.8%, which was the highest level since the fall of 2011, and that was the bottom of the last correction in the stock market, and we pretty much started our way, heading higher after that level was in there. Now, in addition, we saw the percentage of advisors looking for a correction this week remained above 40% for a fifth week. And what that means is that the professionals are kind of shying away from buying the dips at this point, which is also bearish, which means that you're going to have some of the hedge funds come in and might be able to make a move on the market, which could signal that we're close to the bottom. Okay, last week I showed it this chart before, and what this shows is the VIX, where last week it surged to 53.3, which was the highest level in about 4 or 5 years. And I wanted to show you that when the VIX actually surges above 40, it usually usually means that we're probably not going to have a V correction. If you look back over here in 2010, the VIX crossed above the 40-50 level, and we actually had about a 5 or 6 month pullback in the market before we were able to take off again. Over here, the VIX jumped again back in the fall of 2011, and once again, it provided about a 3.5 month in a sideways pattern before we could take off higher again. Happened didn't quite hit in the 40s back last October, but it got up to around 30 plus. So we did have a V correction there. Okay, over here we got the 53.3, which was again a multi-year high, which indicates that we may have some backing and filling to do over the next month or so before we can see this market take off. That is a little bit in contradiction to the bearish sentiment, but it is something we want to take a look at. Okay, one other thing before we look at the sectors that see if there's anything positive going on. That would be, we want to look at the internal breadth and see how, see how this is what I look at as a leading indicator, and we want to see if that's any showing any signs that we could be bottoming out. This is a chart of the NYSE advanced decline line. You can see it's stuck in a series of lower highs, lower lows, and this can actually be found on the Market Edge homepage. In the upper right-hand corner, if you click on Market at a Glance link, you'll get these charts along with the new 52-week highs, new 52-week lows. But you saw the last couple of days we had a little bit of back and filling. What you want to see on this chart, if you look at it once or twice a week, if you can draw a trend line down from these previous highs over here, and see if we can get this line here coming up on a good day, and today certainly will help, where you get the thing trading back up here around 1320 or so. It would be an indication that investors are coming, they're starting to accumulate stocks at these beaten down levels. Okay, the next one, here's the NASDAQ advanced decline line. And as you can see, this really fell out of bed back here in July, the last week or so. Again, we've had a nice move off of this bottom. You want to see the trend line that you could draw down through here. If you can get this thing up about 4,000 or 5,000 units, would be bullish, positive divergence for the NASDAQ. And again, you look at this on the Market Edge homepage, and it's updated every day, so you can see if there is any problems there. Okay, I want to shift away real quick from the stock market charts for a minute. I want to look at something else. I wrote about this in my weekly letter to the Schwab's active client. We have a lot of investors that's on TV or whatever calling for a possibility we may be going to a recession, that China's slowdown in particular could throw our economy and Europe's economy into a recession and their slowdown. Well, first off, obviously the Federal Reserve thought there was a chance that we were going to be talking about a recession. They certainly wouldn't be thinking about raising rates. They'd be talking about maybe another quantitative easing. And in fact, the Fed's calling for economic growth of about 2% in GDP going out over the next several quarters. So that's not heading into a recession. But what investors can focus on if they start to think about a recession would be they could focus on the yield spread between a 3-month Treasury and a 10-year Treasury note. And I got this chart off of the New York, the Federal Reserve of New York. And what it shows is when the yield spreads are moving higher over in here, we're in a strong economy. When it's declining, we're in a less vigorous economy. And when it actually gets inverted, it predicts a recession within the year. And this simple calculation has successfully predicted the last 7 recessions. Last time we had an inverted yield curve was December 2007, before the financial crisis. Okay, this chart is about a month old, but it shows that the yield spread between the 3-month and the 10-year is about 2.10. Okay, this next chart shows the probability of a U.S. recession predicted by the Treasury spread. As you can see down here at this 2.12 level, that is showing right now that we have about the Fed determined that we have about a 3% chance of being in a recession 1 year out from now. So that is actually giving should give you some confidence that this is probably just a sell-off or a correction in a ongoing bull market, and that the Fed sees the possibilities for stronger growth going forward. And until this thing would get up to the yields were almost flat, the chances of going into recession are less than 20-30%. So hopefully they'll take a look at that and see, and not be quite so worried about where we're headed over the short term. Okay, a quick look at the different sectors. Here's the energy sector, and as you know, I've been telling you to stay away from this. So you might be able to get a couple quick oversold bounces in energy. But one thing I did like that I saw here recently, I saw a little bit of a bounce in the relative 14-day relative strength. Just a small bounce, not much of one over here. Relative strength, they had a little pickup. You're actually outperforming the S&P 500 over the last week or so. But again, this still looks quite weak. I think what you want to do is you want to keep an eye on the $45 level for crude oil. I think that's the line in the sand. If the crude oil falls back below 45, it'll probably mean continued weakness in the energy sector. So unless you're just going for a bounce on some oversold days, I would kind of still clear away from the oil stocks. Okay, here's the materials sector. Again, you can see it also broke a long-term trend line going back to about 2009. Here's the up-down ratio showing that people are still selling these stocks even in the strength. The relative strength is bearish on this. But again, you're going to have some oversold bounces when this occurs occasionally. So that's something you want to take a look at. But I would shy away from the materials other than just for a bounce. Okay, next we have the industrial spider. And as you can see, this came down and actually ran into its long-term support line. Industrials were fairly weak, mainly due to the international exposure and the exposure to the stronger dollar. But the up-down ratio is kind of flattened out a little bit. It means you have some people starting to accumulate stocks in here, stocks like GE that have just gotten hammered in the last couple of weeks, United Technologies, stocks like that, 3M mining. They have been beaten up, down 25% or so, and you might see some buying going on in those in here. Also, the relative strength is about flat, so the industrials, after underperforming over in here with the S&P 500, are beginning to show some sponsorship by traders. Oversold bounces, you could begin to accumulate small positions in the industrials. The financial sector has outperformed. Actually, it was one of the leaders through the summer. In fact, the closer we came to expectations that we would get a rate hike, the better the financial sector performed. We are holding around support over in here around 22 and a half, 23. The up-down ratios, you saw right in here a big drop off of distribution in the bank stocks. That was, again, it's a rate hike on for September, is a rate hike off. In this case, the financials are telling you that we probably won't get another rate hike in September. I think also the odds right now are around 30%. People think we're going to get a hike. But if this would come back down here to the trend line, I think it would represent a great buy for the financial sector. Rates will be going up sooner or later, and as we get a chance on oversold, we can get oversold stocks on there. That's the stocks that are in good shape. J.P. Morgan, Wells Fargo, even Bank of America looks cheap in here. You could pick those up on days that we've had a good sell-off. Okay, next one I want to take a look at is the tech sector, or the tech sector. Again, the chart looks pretty decent. We are getting some distribution over here. A lot of this, I want to go into something. I want to show you another chart on this, was extreme weakness in the semiconductors over the last couple months. And I do think the semiconductors may be an area of the market where you could begin to accumulate shares. Here's a relative strength. It's been going sideways a little bit over the technology sector. A lot of this was due to some of the big internet stocks, Facebook, Google, Amazon, that a small selection of the technology stocks really had the tech sector outperforming for a while. But again, they are under distribution, not heavy selling. I want to show you this stock here, the chart of the Philly Semiconductors. And as you can see, it really got hammered over here. It was down probably close to 20% at that level. And now we're starting to see a little bit of a bounce in the relative strength versus the S&P. And over here, I believe you had a little positive divergence where it held above the October 2014 low. In this case, I would look at stocks like Intel, Micron, that have gotten beat up. I think Intel's gone from about 38 down to 26 or so. It's bounced up here on 27.5, 28. They're showing relative strength. I think that you could probably start to nibble away to the semiconductors here. I wouldn't advise going all in by any means, but these are some areas that look like they're starting to show the beginning signs of having a little bit of a bottom. Okay, here's the consumer staple stocks. This would include more of a defensive sector, staying well above the long-term trend line. This would be a place I could pick up cheap stocks. This would include stocks like Colgate-Palmolive, Kimberly-Clark, where they have most of their revenues and sales here in the States and not spread out overseas. Now, Procter and Gamble, it does have a lot of international exposure, has been beaten up so much. We can take a look at that stock later on. That may be showing signs after underperforming the other stocks in that sector. Maybe one that for the dividend and all that you could take a look at. But consumer staples is a defensive play. I think over here you're starting to see down there at the bottom that it's starting to outperform the S&P 500. Maybe a place to look for some ideas. Here's the healthcare sector, which has outperformed over the last couple of years. We did see some weakness over this in the last 2 weeks. I think that's probably due more to investors that have some pretty healthy profits in the healthcare sector, especially from this run over here over the last couple of years, that they just probably wanted to lock in some profits and not give it back to the market. The up-down ratio over here is basically kind of flat, which this was negative divergence while it was going up here over the last year, but now we've kind of bottomed out a little bit. In relative strength, we're kind of performing sort of in line with the S&P 500. I would probably go back into some of the healthcare stocks, maybe even some of the biotechs on some bad days. I will chase the stocks at that high at this point. Part of that is also because the big pharmaceuticals pay good dividends, but those stocks with the big dividends become a little less appealing in a rising interest rate environment. And once we begin the cycle of higher rates, that may take a little bit of the luster off some of those pharmaceutical stocks that pay the big dividends. Lastly, we have the consumer discretionary sector. Great looking chart. It's bouncing off of the 200-day moving average right in here. Hasn't broke that. Again, not a lot of heavy accumulation at this point, but it is outperforming the S&P down here at the bottom. You can look at the relative strength by a big measure. This would include stocks in the home builders, retail stocks. The home builders, we like Toll Brothers, Pulte Homes. Retail stocks that are get most of their sales in the United States. You can look at Lowe's, look at Home Depot, look at Ulta salons. They have a great little product, good looking stock. And these would be areas that even on any weekdays, I think you could pop in here and start to accumulate shares of that. Okay, last thing I want to show you again is this is the United States Oil Fund. It's not the futures of oil, but we did see a nice bounce here over the last couple of weeks in oil stocks. Over here you can see a pretty nice little bit of accumulation. Relative strength was good, and again over here you're seeing the relative strength. It was outperforming the S&P 500. I'm not wild about about the oil stocks yet. If you can see this trend line in USO go above this maybe 16 and change, that would be good. In order for this to get above that, you're going to need to see the WTI crude oil futures probably trade above in the $46, $47 range. As long as it stays above 45, you could be beginning to see the bottom. But the bottom may be in. If it breaks below the 45 and heads towards 40, we could get another retest of those lows a while back here around $37 a share. So I still think the oil stocks at this point are still to be used for trade, not for building up long-term investments at this point. Okay, another one chart that is showing a little bit of a positive divergence, and that's the Dow Jones Transports, which were beaten up pretty bad all year. They've been underperforming. But over here, you can start seeing the up-down ratio shows that you are starting to get some accumulations. The cheaper oil is good for especially the airlines and trucking stocks. Down here, the third graph down here, you can see that it's outperforming the S&P 500. So that means that you are getting some institutional buying going into the transportations. That would be good. We talked about this several times over the last couple of weeks. Ideally, we'd like this needs to get back up above 8,000. Today, we're right around at 79.83. So you have a nice move in this here. Again, I'd like to see this thing close above 8,000, then make another run at its downward trend line around 82, which would be bullish for the overall market if we could get that kind of positive divergence. Okay, to wrap it up, look right now it's a little bit too volatile to call a bottom in here, but there are signs of bottom. If it's not already in, we could be getting close. The Fed meets again for their FOMC meeting in September in about a week and a half, 2 weeks. I think until the Fed gets their meeting in, the volatility is going to remain. But just keep in mind that the market hates uncertainty, and even though we hear the IMF and some of the other European central banks plead to the Fed that the stand pat on interest rates, the Fed watcher over to CBOE projects that there's about a 30% chance that the Fed will raise in September. It's possible that they do. If they do, I don't think it would be surprising to see the market maybe do a quick snap down, but possibly even build off of a rally off of a quarter point rate hike. And that would be because that would be removing the uncertainty it's been going on in the market, and that could set us up for a rally into year's end. So today, as we're wrapping this up, the market opened up about 350 points, very bullish. We did not get into even up to the top of the resistance ranges on any of the different indexes, but we were close. If we could hold this gain and then possibly build on it, that could push the broader market into the 50% retracement level, which would be quite healthy for the market. If we see today's rally fade and possibly even sell off a little bit tomorrow, that's going to keep an eye that a lot of traders will be watching to see if we're going to go down and retrace last week's previous lows. A close below Friday's level. If you could take a look at those on the different on the front of the home page of the Market Edge or in the charting package, a break below those, I would pretty much count on a retest to occur within the next week or two. But again, we got some signs that some positive signs in the the bearish sentiment, and that we see some positive divergence in the transportation index and possibly even the semiconductors. So we don't have time for any questions today. I apologize on that, but we will be back next Tuesday, and you can get a link to today's meeting. Just to listen to it at your own leisure later on today. So thank you for joining in, and we'll talk to you next week.